All right, good Wednesday morning, everyone. We are on the floor of the New York Stock Exchange with Jim Cramer to talk about the markets and the tech sell-off. The NASDAQ down almost 1%. Jim, take it away.
Yeah, look, I think that the froth is coming out of the market. We've seen the Tilrays go up every day. The Canopy, Advanced Micro, I think that stock is cheap. I understand, but the stock has been going up, up, up. We're wrenching some of the froth out. We've been saying, we looked at the Cloud Kings and wrote about them yesterday, and the idea is that when they come down, from exogenous events, and maybe it's in part because of what's going on in Congress, in part because of what's going on in Workday, that you want to buy them, that you pick one. I suggest that people look at Salesforce as that stock comes in, a very good quarter. Workday is precipitating this decline, and yet Workday was a very good quarter. Some people feel that the bookings weren't strong enough, or that the company has some difficult compare this next quarter. But this is what you get when you, let's say, have an up market. You get something, a Workday triggers a decline. I mentioned one squawk in the street that this market would be about Workday. And it's not about Facebook, it's not about Alphabet, it's not about Twitter. It's about a company that some people feel is integral to the web and to digitization that I thought had a great quarter, but it's not received as great. And that's allowing for a lot of selling to come in. I also think that the cannabis stocks got overheated. When you see an overheated group like that, you have to recognize that sellers will eventually come in. I tweeted many times this morning, where are the sellers? Where are the sellers? Where are the sellers? Well, we see where they are. They're in the stocks.
And on Facebook, on Mad Money last night, you talked about whether it was a broken stock or a broken company.
Yeah, I mean, look, when you watch the hearings, it's very obvious that they didn't get ahead of this. A very damning Wall Street Journal article about, did they even know to get ahead of it, or was it their hubris? I said over and over again, bring in someone from the outside that you can't buy and let the chips fall. They repeatedly snubbed their nose at that kind of suggestion. The board of directors never asked for someone from the outside who, like what Fox did when they brought in Paul Weiss, Wells Fargo. I mean, they brought in big-time outside counsel that couldn't be bought, and wrote long reports that investigated all the different ways and systems that were broken. Where is that here? And the answer is they just didn't think it was necessary, and that's why they're in such trouble.
Essentially, you're saying there's a playbook for how to deal with this kind of stuff.
Right, and I've been writing about it endlessly in Real Money. Now, look, again, I did write in Real Money yesterday. Understand that we are now in a situation where these companies have to spend a lot more money. Maybe have to curtail their growth, as Twitter obviously is when they keep purging accounts, but that's why they sell at such low multiples. I mean, Alphabet doesn't sell as much at low multiple, but remember, if you're shorting these stocks, remember what you're shorting. You're shorting a great balance sheet, you're shorting companies that can buy back stock, you're shorting companies that still have lots of strong businesses. You're shorting businesses that if they had just gotten ahead of White House and gotten ahead of Congress, then we wouldn't be having these hearings. But I don't think they're good. I think that Facebook's come down a great deal. There's a lot of headline risk still as you switch from high growth to value, and that's occurring right now. This is the transition. We sold some Facebook higher. I don't want to buy it back yet, but recognize that this is what happens, like with the banks. When they called all those bankers down, and you have to say, I'm sorry, I apologize, made a mistake, and now they're doing it. Before, I think they tried, but their heart wasn't in it. And this is what happens when you absolutely screw up and have hubris and arrogance, and don't bring in someone from the outside who's a grown-up who says, this is what you must do. Right now, imagine they had done what I asked over and over again. What would happen is those people would have brought the reports that they had that were done by outside counsel that everyone in Congress respects. They could have many outside counsel they want to do. They have so much money. And what you would see is companies bringing in law firms that everyone knows can't be bought, and they would be presenting their reports and what they're doing to execute on the reports, and they would mute Congress. But they didn't do it. Why? Why didn't they? What were they fearing? Were they worried about gross margins? It's pretty shameful.
And in an effort to rebound, maybe that's why they've sent Sheryl Sandberg to testify versus Mark Zuckerberg, someone who's a little bit more experienced in this kind of environment. I mean,
Sandberg really got savaged in today's Wall Street Journal, basically just saying she took her eye off the ball. Look, again, they can apologize all they want, and Congress can't really do that much, by the way, because you're regulating free speech. But obviously, the companies have to spend far more money policing. I think Alphabet did this very well with YouTube, but you know what? Right now, no one's going to defend these companies because the long knives are out, and that's why I'm saying you've got headline risk. And when you couple that with the selling that we're seeing in a stock like Workday, then you got to say, hey, listen, it's a down day for NASDAQ. We are in a weird situation where it's down day for NASDAQ and the money just immediately sloshes over to the S&P. That's a typical rotation, a little bit more whippy than usual. When I mentioned the Cloud Kings, we've got a small position in Salesforce. We would like it to come down much more. This is the exogenous selling that we always talk about that you had to wait for. It's happening now. You tend not to want to buy day one. We got with Rosh Hashanah holiday, we've got very slow day on Monday. You've got a couple days here that I think are going. You have the employment number Friday. There's a lot of obstacles here to just going in and buying, and respect that.
And as you read in Real Money this morning, that employment number Friday, even if it's good, could spark some uncertainty with President Trump's tweets.
I want people to read that. I mean, what's happened is that when the president sees that our economy is doing well, he really takes it to our trading partners, quotes around partners. Look, I mean, he doesn't think any of these countries do anything good for us. And he feels like he has the advantage, and he looks at the stock market, and if you look at the stock market, we do have the advantage. So I totally understand. Now remember, there are people who say, well, listen, you're in the pocket of so-and-so. I mean, he's got positions, a lot of positions in trade that have been my position from the days when I debated Larry Kudlow. I am a free trader when there's free trading, but I'm a fair trader when there is no free trading.
Jim, one more stock we wanted to get to. You have the CEO of Restoration Hardware on tonight. What did you think of the stock's decline today?
Well, look, I mean, he guided down on revs, and he guided up on earnings. When your stock's moved as much as his has, you're supposed to guide up on both. There was a very raucous question at the beginning, basically saying, how could you have screwed up so badly? And then Gary talked about gross margins, he talked about executing the model. Short-term blip, companies doing incredibly well. I'm more concerned about how much furniture they import from China and whether that's going to hurt their gross margins after having a big raise in gross margins. But really what matters here is that they've got a brand new gallery in the meatpacking district that I can't wait to get to. And, you know, Gary's, can you really bet against a guy who bought a huge amount of stock in the 20s and told you it was too cheap? They bought back $1 billion worth of stock when it was incredibly advantageous. This man doesn't just know furniture. He doesn't just know galleries. He knows finance.
Yeah, he made quite a lot of money in that trade as well. Jim, you have a big show tonight because you also have the CEO of Honeywell. It's an Action Alerts Plus holding.
And we got to talk about the breakup. You know, he's got a breaking into residential, breaking into auto, and then into RemainCo. And RemainCo is incredibly attractive. They're all attractive. But we're going to talk about why they're doing it, what you're going to get, and when you're going to get it, and what the new Honeywell, or RemainCo, as they're calling it right now, will look like.
All right, that's tonight, 6 p.m. Eastern on CNBC.
Now, again, I mean, as I wrote this morning in Real Money, the S&P numbers, the big industrials that are doing well, can reverse if the president takes to Twitter and basically hammers all the countries that a lot of these companies are doing quite well in.
All right, Jim, you have one more show tonight before you go to Philadelphia on Thursday.
Doing Comcast Center. I'll be doing my show at 3:45, and then heading down to and I'll be doing my show from the Comcast Center, the 9 o'clock show, and then I'll be heading down to the Link, take the subway, get there on time to watch. I'm not no hubris here to watch the Eagles play at the Atlanta Falcons.
Okay, we'll be looking forward to that, Jim. Meanwhile, Jim and I are going to continue talking about stocks in our ActionAlertsPlus.com video. Please join us there.